Welcome to A State of Mind, Law, Legacy, and Life with Sunny.
Hello, everyone. Welcome back to A State of Mind, conversations on law, love, and legacy with Sunny Rickard, principal attorney at Rickard Law APC. Sunny works with families across California to create estate plans that are not only well designed, but also properly implemented so they function the way they're intended to. My name's Sean O'Connor, and today Sunny and I are focusing on a step that's often overlooked, funding your trust, and why it plays such a critical role in making sure your plan actually works. Hi, Sunny. Good to see you.
Hi, Sean. Good to see you too. Glad to be here. This is actually a topic I genuinely passionate about because it's where I see the biggest gap between the people think what they have and what they actually have. So funding is the part of state planning that turns a stack of papers into something that actually works.
It's like funding the trust, in my mind, it's like it would happen automatically, so to speak. But I know we're going to get into the details of that. And so, what does that mean to fund a trust? And then, of course, why is it so important?
Right. So funding the trust simply means that transferring the ownership of your asset, your house, your bank account, your investment, out of you individual name and into the name of your trust.
Got it. So
That's
if in my case, if I owned a house and I've got this, vacation property and I've got a business interest and they're all in my name, probably.
right.
And so the trust, what I need actually is changing. I'm changing the title to the house to be trust incorporated or whatever the trust is called.
Right. Sometimes because when you're alive, when you're capable, you are the trustee, you are the representative of your trust. So even though, like Sean, you transfer the property from Sean to Sean's trust, you can see still your name,
Right.
Sean O'Connor, but it's not as individual, but as the trustee of your trust.
I
So,
see.
the title it's not you individual anymore, but it's a, it's your trust as the owner, not you individual as an owner anymore.
So, and you mentioned property accounts, that sort of thing. I'm curious, okay, we've created the trust. What types of assets are typically intended to be transferred into it?
The general rule is everything that has a title, right? If the
Okay.
house you have a deed to
Mhm.
present how the title is, how the property is held. Maybe the title is your own. Maybe the title is belongs to you and your wife and your spouse. Maybe that title is belongs to not you and your children. You maybe only have a fraction of title to a property that's real property. And the bank, of course, that your name is going to be on the bank account.
Mm.
That account belongs to you. So pretty much everything you can have a title. The real
Okay.
properties, the bank account, the investment account. The only the asset actually in the different category when talking about a title is retirement and the life insurance. So yeah, we're talking about rental properties, vacation homes, undeveloped land, and yeah, the all sort of investment account, and most of the time maybe also include your digital properties like the cryptocurrencies.
Oh,
Those all have a title, and
got it.
those all need to be retitled into your trust.
Is that, the retitling that you mentioned, is that, how does it work? Is that complicated? How do people go about doing that?
Let's talk real estate first. Real estate because that's the most kind of
Right.
uh,
That's the common.
most valuable, and
Mm.
sometimes it's most valuable your asset. So the transfer real property into the trust actually is signing a new deed. Usually it's a grand deed or quit claim deed in California.
Mm.
That transfer of ownership from yourself as an individual and then to yourself as a trustee of your trust. Um, so so the deed can read something like, Sonny Rickard, a married woman, transferred to Sonny Rickard, the trustee of the Rickard Family Trust, dated such and such. So deed is then recorded with the county recorder's office, and sometimes you also has to file a preliminary change of ownership report, the PCOR, and one of the important California specific point is transferring a real property from yourself to a trust will not trigger the property tax reassessment. So that's can put most people at ease. It's transferring not going to trigger the reassessment, and not most of the time it doesn't have the title tax is the transfer tax as well. So the financial accounts, you actually need to contact the bank or personally go to the bank to ask the bank to do that for you. And then most banks can keep your account number and just change the name of the account. Some of the banks maybe say, hey, we cannot do that. We have to set up a new account. In that situation, you can politely push back. And because if you set up a new account, then this account probably, the old account probably already have automatic payments set up, already have the direct deposit set up. So if you have a new account and close the old account, you have to this extra work. So gently push back, say that I don't really want a new account. Sometimes the bank has their own purpose to ask you to open a new account. But if the bank insists that no other ways, my recommendation is don't close the old account. Set up new trust account, and also establish automatic transfer between the trust account and or your old banking account.
Great idea. Yeah.
Right, but keep the balance of that old banking account to a minimum, just enough to make the regular payments, so on and so forth.
Right.
Same as the investment account. You have to contact the institution to ask them to change the title to that account into a trust account. And most institutions have their own policies, their own process to do. And I have to say that most institutions know how to do it. You might have to file some internal paperwork, but most of the time, if you provide the certificate of trust and telling and inform them that you want to change the title, they can. They are happy to assist you to get.
They know how to handle that.
Yeah.
When you were reviewing estate plans, maybe a new client comes to you, or they had set up a trust, or they have an estate plan. What are some of the most common assets that end up being left out of a trust that you've seen?
You'll be surprised. Number one, actually, by a wild margin, is the real properties that's were purchased after the trust was created.
So they didn't update the trust.
Correct. And someone signs their trust in 1918 and dutifully transfer their existing homes into the trust. And then in 2022, they probably purchase another real property or vacation homes or a rental property. And they forgot about the trust, that they take the title in their individual names and never just think about it. So when they passed away and the new property just did not title in the trust, has to go through a probate again, especially in California. The real property assets has such a high value, so it's inevitable has to go through probate again. Number two, the bank and the credit union, the bank account that were open sometimes after the trust is funded as well. People sign up for a new high yield saving account, especially in the past few years. Some of the interest rate was really, really good for some saving account, and then they forgot to title them into the trust. And number three is a business interest. Someone has a LLC or has a corporation or has a partnership with somebody, and those interests was not transferred into the trust. And the number four, I think, is the out-of-state properties. That's maybe you inherit some property in some other states, or you have some I don't know, vacation fraction of vacation homes interest in out of state, and so that sometimes just totally forgot about it. The thing is, if you have a piece of real property in other state, that can trigger we call ancillary probate. You have to open the probate in two states, basically. That's dramatically increase the time and the cost.
That's something you'd want to avoid. It's interesting because, I mean, somewhat ironic, right? Because we talk about people getting these estate plans, trusts, and those things. You know, you get it taken care of so you don't have to worry about it. And so then you do that. You get it taken care of and you kind of forget about it because you're like, I did it. It's all good. And so this conversation tells me that people should be updating or reviewing their trust documents. How often? Every year? Every 5 years? I mean, obviously, if you buy a new property, you should, but like what's the best practice there, Sonny?
I think in rule of thumb is every 3 years, 3 5 years, at least
Okay.
five. Every 5 years you should review your trust. But when it's as needed as there's some life changing event happens, you
Mhm.
bought a large piece of property, you won the lottery, right? And
Yeah,
you
you got married,
divorced,
you got
you
divorced.
remarried, when
Right.
and or the tax law has changed, and the tax law almost changed every administration in these years. So when
Mhm.
those kind of important event happen, you should review your trust right away to make sure that all the property is entitled correctly in the trust. The beneficiary is still who you wanted to inherit your assets, and your trust still abide to the tax law. Will not kind of in the future increase a lot of income tax or incur that state tax if you pass.
Hmm.
So yeah, this that's every 3 to 5 years. I think definitely you should review trust documents, review what kind of property you own, review what kind of debt you had. But if there is something important change in your life, you should review your documents right away.
Great. That's clear. Good. You mentioned earlier, retirement accounts, life insurance. I know there's certain assets that, you know, pass through a beneficiary designation, right? So like on my life insurance policy, I have my daughter listed as the beneficiary. How do those kinds of financial assets, I guess, how do they fit in the overall estate plan, alongside the trust?
Right, this is a very important and the most misunderstood piece of puzzle. I want to explain a little bit in details with how these properties in coordinate with the trust. The retirement accounts like IRAs, 401ks,
Mhm.
403bs, and the similar, and the life insurance policy usually don't transfer through the trust, and they transfer through the beneficiary designation, and um, so when you open an account or sign up for the retirement policy, you always kind of in those forms, there is a item you have to fill in who is
Yep.
going to be the beneficiary, who is to be the primary beneficiary, secondary beneficiary, and who is a contingent beneficiary. Um, so so the first piece of the advice, actually, you look at your beneficiary designation, put them up. I cannot tell how often I found that, but the designation, the name on the beneficiaries list is actually is your ex spouse. Is
No, of course.
you
Right.
divorced many years ago, and
Yeah.
when you marry, you put your spouse name as a primary beneficiary. After you divorce, you just never think about to change the name,
Right.
and sometimes a deceased parent is on the beneficiary's designation.
Mhm.
So those, if those forms not updated, sometimes it's inevitably those assets still have to go through the probate. Um, but some of the uh, assets, actually, you can list the trust as the beneficiary. I see that more often in the life insurance policy. You can say, hey, I have a life insurance that is worth $3 4 million. I don't want to just give this right away to my children. I want this property to be protected once I pass on to my next generation. So that actually, if you list a trust as your beneficiary, actually can achieve that asset protection purpose.
I
So,
see. And
yeah,
then you would leave directions or instructions within the trust documents that would, the plan for that money is
Exactly.
XYZ. I see.
Right. And you can, in the trust document, you can say, hey, you cannot use the property I passed on to you to pay your creditors. You cannot use the property I left to you to pay your alimonies and so on and so forth. So that's how actually those funds, if transferred to the trust, actually has as a protection function to help your beneficiary to preserve
Hmm.
those assets.
That makes sense. So interestingly, then, so if I'm reviewing my trust documents or my estate plan every 3 to 5 years, then part of that plan is also, okay, who are the beneficiaries on these different accounts, and are those still the proper beneficiaries? That's also part of a key part of that review process. It sounds like.
That's correct. Yes. And the 401ks and the retirement account has different kind of uh, rules because after the 2017 we passed a new law, and so it shortened how long the tax can be deferred after one person's passed away. Usually, is when I passed away, I can transfer my IRA account to my children. Then my children can defer the tax in his or her lifetime. But the
Mm.
new law changed that. So the longest that you can defer the tax is 10 years for the qualified beneficiary. And for disqualified beneficiary, the rule of thumb is you can only extend that tax defer period to 5 years. So if you take those money out, you're going to face the income tax immediately. Um, so in those situations, we usually recommend that don't uh, put the trust as your beneficiary, but put probably your surviving spouse as the beneficiary, because the surviving spouse is exception. The surviving spouse actually can extend that tax defer in his or her lifetime. So that use that kind of designation, you probably can stretch that tax defer benefit much longer than 10 years. Um,
Mm.
if you use trust as the beneficiary, then there's a certain kind of language provisions you need input in the trust to make sure the trust becomes a qualified beneficiary. So the tax defer can be stretched for 10 years instead of 5 years.
Got it. That sounds like a future podcast topic, the tax ramifications, and because it. I have questions about it, but we don't have time right now. We've got just a minute left, Sonny, and I'm just, as we often do in these things, someone's out there listening right now. They've got a trust in place. What should they look for to confirm that their assets are properly aligned with their plan? What are a couple of things they should focus on?
Yeah, as we have talked about, Sean, you really have to think about how you want to pass on your legacy.
Hmm.
What is most important for you is just give this asset to my children, or I want to protect this asset to pass on my children. And another thing is what kind of asset you have.
Yeah.
You have you know, you list out. You need to put a list out. You what kind of asset you have, what real property, bank account, investment account, life insurance, business interest. So all this asset you have to list out, and different asset have different kind of ways to pass on uh, to the next generation. So you have to think about it easy beneficial designation or retitle to the trust. So those are very important if you want this plan actually works for you.
Got it. Super helpful. Thank you, Sonny. Great to talk to you.
Thank you, Sean. Nice to see you again.
That's it for today's episode of A State of Mind, Conversations on Law, Love, and Legacy. To learn more about how to properly fund your trust and ensure your estate plan works the way it's designed to, visit Sonny's website at rickardlawapc.com. Thanks for listening. Do us a favor, leave a review, subscribe, maybe share a link with someone in your world who is working on their estate plan. That would be great. I'm Sean O'Connor. Have a great day.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.